Hi, I'm Jay, escobarj.com, and this video is why investing is better than saving. I've done one video on this topic so far, and I've done a previous video a few months ago on this topic, kind of covering a broad spectrum of this. But I'm going to kind of break things down in a little bit more detail in this little series of videos. And today, and by the way, if you haven't checked out those first few videos, the first two, I'm going to go ahead and link them down into the description. So make sure you check those out first. But today we're going to be talking about higher returns. So here's the deal. If you decide that you're going to manage your portfolio yourself, even if you don't really know what you're doing, if you don't know a lot about investing, trading, stocks, mutual funds, ETFs, IRAs, etc., whatever, all you have to do is just follow a simple formula. And this formula really goes for, buying and selling anything. And that formula is just to buy low and sell high. I mean, that's been around for centuries. It's just buy when things are low and then sell them when they're high. And you make a profit every time, right? And a lot of people just complicate things too much. So the first thing you want to do is you want to invest in companies that you know and you're familiar with. Because if you invest in companies you know and are familiar with, you have your finger on the pulse of the market, which means you have not necessarily insider trading, but you have a good idea of a company that you're familiar with. For example, typically there's going to be some of the bigger companies, the Nikes, the Amazons, the Teslas, the Boeings, the banks, the big bank companies, right? And other big companies, big corporations that you're very familiar with, or brands you're very familiar with. And if you want to get a little more risky, if you work in an industry that maybe people don't really know as much as you do about, maybe you're an expert in a certain field and there are companies that you know about in your field, then you can invest in those types of companies if you really have your finger on the pulse of the market. And you will have an edge over everybody else who doesn't. But essentially the idea is you want to invest in companies that you're familiar with and you pay attention to, that you genuinely like their products, because you follow them, you know what they're doing, you essentially have a commitment and an understanding of what that company is doing. And so after you have your finger on the pulse of that market and you've got a few companies that you like, then all you really want to do is just look at the Dow Jones, the NASDAQ, the S&P 500. You just want to look at those as a whole first and look at the days that are red. Whenever there's consecutive red days, those are the days that you want to buy stocks. And then once you see that those red days are red, then you look at the companies that you're familiar with, the ones hopefully you've written them down, or you keep track of them somehow, and you look at what they're doing on those red days. And you want to pay attention to the news on those companies on those red days. So those are the three things. You want to pay attention to the overall trajectory of the market, which is looking at the Dow Jones, the S&P 500, the NASDAQ, etc. Look and see what the market did for the day or is doing for the day. Then you check out the companies. You look at if there's any major news. If there's major news, like a company is going bankrupt, then obviously you don't want to invest in that company because you're going to lose your money. But if there's no major red flag news, but there's just a down day in the stock market and you have consecutive down days, those are the days you want to buy that stock. And then simply wait for consecutive days that are green in the market. It's just the exact opposite. You look at the trajectory of the market as a whole. You look at the S&P 500, the Dow Jones, you look at the NASDAQ, and then if it's green for consecutive days, then you find the same companies that you have stock in. Make sure, you don't even necessarily have to look at the news on those days because it's green, right? That tells you things are going well. And hopefully by this time that you've held on to it, you've made some profit in between that time that you bought it red and that's at green. Now, if it's like 2 days were red and then 2 days were green and then you sold. I mean, you can make money like that quickly, but you can also make some bigger gains if you trade at a weekly or a bi-weekly level. So that's really the premise behind just getting higher returns. And if you do it this way, if you repeat that process over and over throughout the entire year, first off, it doesn't require a lot of your time because you can trade on a weekly or bi-weekly basis, which means you're making small incremental gains every couple weeks, and hopefully you get some big gains in those times too. And you don't have many losses, but sometimes you'll have losses, but for the majority of the time you'll have gains. And you can trade like this, again, like on a weekly, bi-weekly schedule, and it doesn't take a lot of your time. It's fun. And when the market has that upward trajectory, you'll be confident that you'll get, at least a 10% return on your money for the year. And honestly, it's going to be probably more like 20 to 30%. Now, obviously, nothing is guaranteed when you're trading, when you're investing money, nothing is guaranteed. So, you can't just expect to gain every single stock trade you make. That's just unrealistic. And, some years are going to be better than others, and some trades are going to be better than others. And you may have some trades that are amazing and some trades that are not good. And you learn a lot in the process just by simply doing it every week or every other week. You could literally trade, or every month if you wanted to, if you really don't have a lot of time. And if you just do that every single year, you're going to make at least 10% on your money. It's just bound to happen because you're buying low, selling high. And even if you're making small incremental gains, that return is much better than having your money sit in the bank, literally doing nothing, hitting inflation, which is decreasing the value of that dollar or those dollars you have. It's better than investing in a mutual fund. The average mutual fund gets like 4.74% return or something like that a year. And that's pretty low. And that will probably barely cover the cost of inflation. If not, it would probably be slightly less. It's better than an ETF. ETFs are a little bit better. They're like, average I think is like 12% for an ETF, 10 to 12%, but they're a little more risky. But you're just basically giving your money to a big pool, and some investor out there with access to this big pool of money is trading it for you. And it's better than giving your money to someone else to invest it for you, because that person is most likely going to take a cut, after a certain percentage. Maybe they'll say, oh, I can get you 5% or 7% or 8% on your money. And, they won't tell you that they're going to take anything excess of that, or they'll take a fee. They'll give you all the gains, but they're going to take a cut, right? So if you just cut all that out and you just trade yourself with exactly the formula that I just told you about, buy low, sell high. If you buy something on a red day, even if it goes a month or, a week or 2 weeks, 3 weeks, a month, and you're floating right around the same, eventually it's going to get to the point to where you make a gain and consecutive green days, and you cash out on those days and you capture that equity, and you do that over and over and over again. And eventually you're going to hit 10, 20, 30% on your money every year. It's just inevitable if you just stick to that simple, fundamental process. And that is how you get higher returns. That is how you get higher returns. And that is why investing is better than saving. So, and that's the second reason. I have 3 more videos after this. So be prepared for those. Check those out. Hit the little bell icon. Make sure you subscribe. Hit the little like button and subscribe, and hit the little bell icon so you don't miss when I release these videos, because I'm going to talk about some other cool strategies that you'll really like. So keep an eye out for those. And then at the very least, you can visit my website at escobarj.com if you'd like to book a coaching session with me on this topic. If you're struggling with your investing, etc., you can book a coaching session with me. Shoot me an email on my website. And if you'd like, you can make a donation. You can donate any amount of money you feel is worth or equal to the value of the information given in this video or any of my other videos. And then if you would be so kind Share this with your friends and family on any social media platform. That is my purpose, is to help as many people self-actualize, grow, become the best versions of themselves in every category of life. And that includes monetarily as well. So that being said, I hope you're always learning, always growing, and always pushing forward. And I'll see you in the next video.